let's set the scene here on what delaying 10% tariffs on $300 million worth of goods, at least some of those, though we have yet to learn exactly what gets broken out. Why such exuberance or optimism, a turnabout on the part of the market?
Yeah, I mean, I think this optimism is a little bit premature. I mean, I think this is really just business as usual when it comes to trade negotiations. We have seen that ratcheting up tensions when things are looking good and then dialing them back down when the dust has settled a little bit is standard operating procedure when it comes to these negotiations. We got a little bit of good news today. I don't think it's long-lived. I would not be surprised if we see more escalation at some point in the next couple of months or even weeks.
You wouldn't be basing your investing decisions right now on this bit of news coming out from the trade representative?
Not a whole lot. I mean, my base case still, as we move into the election season, is that we do start to see some more permanent progress being made. But I think that today's news is just one of many instances of things dialing up and then dialing back down again.
Tom, set the scene.
Well, it's a difficult time for investors, right? Because tweets move markets more than wars. And I think it's very confusing. And I think at the moment, it's easy to build a bear case because we can say, hey, look, this could lead to a recession or a depression. Look at bond yields. But the markets have panicked. I mean, if you look at AAII sentiment, it's at extreme readings. The VIX term structure is inverted. We had a 3% decline. These are massive buy signals in the past. And so unless something is completely different this time, as difficult as it sounds, it's a huge buying opportunity right now.
So your second half monster rally thesis is intact?
Yes.
And bolstered by today's action? Or is this, I mean, some will argue this is a sucker's rally, today's action, in a thin tape?
Well, as you know, all rallies start with short covering. But it just shows you how tilted sentiment is. I mean, we have just a mild shift in sort of the trade tensions, and we get a huge rally in markets. It tells you what kind of move we can expect if trade tensions ease. And I'm not saying it's going to happen the next week, but look, the U.S. economy's huge economy. U.S. consumers are 40% of global wealth. I mean, it all depends on how the U.S. consumer does, and I think they're fine.
We've seen a lot of fear the last few days driving the moves on the market. Are investors just looking for any silver lining they can find to be optimistic?
I think they're both looking for any cracks in the armor to get scared about and then any silver line to get excited about. We are 10 years into this bull market, 10 years into this expansion, both record highs for this economy, for this stock market. There's a lot of anxiety out there right now.
And how do you think that the fact that we're sitting on the edge of an inverted yield curve plays into that?
I don't think the yield curve means too much, and I don't know, maybe I'm oversimplifying here, but we are living now at the tail end of a 10-year period of unprecedented, unorthodox monetary policy, not only here, but around the entire developed world. If nothing about today's bond market is the same as it was even 10 years ago, why can we think of the yield curve in the same way?
For those who hedged in recent weeks with gold, silver, treasuries, do you think they should take that hedge completely off? Half off?
I mean, I think the hedges that are out there are valid, whether it's gold or Bitcoin, because we've got 45% of bonds outside the U.S. trading at negative rates. So clearly the world is not thinking about interest anymore. They're thinking about capital gain. But, you know, I think all of our clients think this bull market is late cycle on its last legs. It kind of reminds me of my dad. You know, when he was 50, he told me he was old. He's 87. He still golfs every day, drives, and he still says he's old. I mean, he's going to be old for a long time, I guess, you know. And I think this bull market is mid-cycle. I mean, so I think everybody who thinks the 10-year bull market is the end are the same people that might have faded this market in 1992. And
I'm pretty sure you should clip this and send it to your dad to make sure he knows that you have compared him to the longest bull market ever. When you're thinking about the global market and investing opportunities, where are you finding value right now, Jack?
Short term, I think the international landscape is challenged as long as tariff uncertainty remains. Perhaps pockets of opportunities in the European consumer or parts of Southeast Asia that have gotten really beaten up. I think long term, though,
like what?
I mean, I think that Korea is probably a little bit undervalued at the moment. I think that there could be some potential over there. I think that China is a little bit tricky, but valuations are cheap right now. And if you're a longer-term investor, I think that story continues to make sense. But short-term, I am focusing a little bit more domestically until trade tensions kind of settle.
Does this give Powell even more clearance for further cuts, more aggressive cuts?
I think that's one of the things investors have to keep in mind. The central banks are still the most important entities out there, and the Fed is the most powerful central bank in the world. I don't think the Fed is out of bullets, out of ammunition, or out of credibility. So, yes, it's a huge deal. If the Fed decides that market conditions are tightening, and they are, they could do an even bigger move, and I think they can also use unconventional tools. So I think it's a mistake to fight the Fed.
The consumer price index came in at 0.3%. Exactly where it was expected. Does that change at all your calculus?
I think that we're probably in a weaker inflation environment just because of what the 10-year is telling us. But I think people are going to mix falling inflation with cyclical downturn. The long-term yield curve has been steepening, and it's been leading the ISM by 16 months. So it tells us that this inventory correction, the cyclical slowdown is ending, and we should see stronger growth next year.